Hi, it's Paddy Hirsch at Marketplace. Corporations are a lot like people, especially when it comes to determining their worth, or their valuation as it's called on Wall Street. I mean, take this person, Rachel, for example. Say you're an employer, right, and you want to hire Rachel. Before you do that, you want to get a sense of her worth, and there are a couple of ways of doing that. The first way is to go out and ask people. So you might go and ask people she's worked with in the past what they think of her. The second way is a lot more rigorous, or it requires a lot more work. You've got to get into the books, right? You've got to find out what her work history is like. You've got to find out what her school history is like. You may even find out what her bank history is like before you hire her. And this way, you're going to get a sense of what her assets are, what her liabilities are, and maybe what her prospects are going to be as an employee at your firm. Well, the same thing goes with companies. Rachel here has now become Rachel Inc. All right, and there are a couple of ways of finding out what Rachel Inc. is worth. The first way is by asking people, and the answer is actually right there. Here it is, $50 a share. That's the easiest way to find out what people think of a company. It's right there in the share price. And once you have the share price, you can work out something called the market valuation. All right, and the way you do that is by multiplying the share price by the number of outstanding shares, in this case 1 million, and that gives you a nice tidy answer of $50 million as the market valuation of Rachel Inc., also called the market capitalization. Now, the other way of finding out the valuation of a company is a lot more tricky. It's a lot more hard work, right? It's something called the Fundamental Valuation. And when you do this, it means you're starting to get into the company's books, right? You're looking at what the company does, how much it earns, how much debt it's got. And this much more rigorous way of doing a valuation often drives the market valuation, obviously, because there's a lot more detail in it. The problem is that a lot of investors, instead of doing a fundamental valuation and a market valuation at the same time, often just invest based on the market price. A lot of the time, they're jumping into a stock price because everybody else is jumping into it. All right? They're not actually looking at the fundamental valuation at all. They're just seeing the price rise and just jumping into it willy-nilly. And the problem with that, of course, is that once reality bites, people see what the fundamental value of the company is, and the price starts to adjust, well, it means that the price could fall very sharply and leave those lazy investors very badly needing a drink.